Big event happening this week. In fact, if you're looking at this after Monday, it's already happened, but 9/9/24 at 1 p.m. Eastern time is the Apple event. All right. What's Apple doing? Well, they're unleashing their new iPhone. This is going to be a big one because not only the iPhone, but the next software release is going to have a huge piece of AI in it. Some are saying this is going to be as big as when ChatGPT was released. All right. Now, while this is a big deal for Apple, the Apple options are neither cheap nor expensive. Okay. So when I look at Apple for a year and I look at where the implied volatility is, which implied volatility is the way that we measure option prices and option premiums to see where they are as far as being cheap or expensive on a range. When I look at Apple options, they're not cheap and they're not really expensive. So what is? All right. This week I thought I would answer that question and talk about options that are cheap and options that are expensive, or at least stocks that have options that are cheap or expensive as we're ending our Q2 earnings. So what I do is I measure IV to determine this. So what we do is we take a ranking of implied volatility. Implied volatility is a percentage that's based on every single option, all right, on a stock, both short-term and long-term options, both in the money and out of the money options. And what we do is we do a ranking of implied volatility against near money options. Those are options that are very close to today's stock price. What we then do is we mark those every day, and we're able to chart volatility. And when volatility is, we're able to get a range over the past year to 2 years, and we get an idea where the highest it's been in the last X amount of time, and where its lowest has been in X amount of time, and where is it right now? And if right now is close to the high, we consider that expensive. So let's take a look at expensive options coming into this week. Kroger, KR, all the way at the top of the list. I want you to check something out here. So this is the highs for the year. This is the lows for the year for this column. And this is currently where these options are at. So when you see Kroger with a 1-year high at 36.04 and a 1-year low at 17.10, and right now it's at 36.04, it's hitting 1-year highs in expensive options. We got Hella on here. It's at its 1-year high. TQQQ is off of its 1-year high. So the top two are hitting 1-year highs right now. Everything else is more expensive than not. But you can see TQQQ is here. The Qs, obviously the Qs, if you saw the kind of movement that the Qs had last week, all right? TNA is on here. SMH, Oracle is also high as we're looking like we're heading into earnings for it. EWJ, SPLG, and MCHP. So a lot of this we're seeing is expensive right now because, and you'll see a lot of ETFs in here and sectors and those leverage sectors on the overall markets, because the overall markets has just been all over the place. So that's a big one. Let's take a look at one. Here's Kroger. So take a look at Kroger, and you can see this just goes back the last 6 months, and you can see what's gone on in the last 6 months down here in the price of Kroger has gone from 56 high to 49, back up to almost 56, then down to around 52 and change, and then you can see it just having higher lows and lower highs. But look at the implied volatility. So here's the implied volatility. The lowest it's been in this chart is 49. The lowest it's been in this chart is below 18. The highest it's been is near 40. So you can see 40 high, low 18. I mean, you've got more than 100% increase in implied volatility. What does that do to an option price? Well, I went back 1 month ago, not back here in July, but about a month ago when it was trading in the 20s. And you can see here's where it is today. So with Kroger sitting in the near money options, you can see the extrinsic value, because remember, it's based on time value. 122 for the out of the money calls, 146 for the slightly in the money calls. All right, you can see the stock price is right in the middle. But you can also see the IVs, 32 to 35. Look where it was a month ago. A month ago, we had the slightly in the money call it had an intrinsic value or an extrinsic value of 106, and then the slightly out of the money call had an extrinsic value of 115. But look at those implied volatilities. There's those big drops from last month to today. Almost double the implied volatility, and you do see the option premiums pop up a bit there. All right, quite a bit. So that's Kroger, just showing you a difference between what double IV can do to options premium. Let's take a look at cheap options. Now, I do the same thing with cheap options. I look at a ranking of implied volatility. We look at the near money options over the last year, and then we look at, well, what's the high been in the last year? What's the low been in the last year? Where is it right now? And these are optional stocks, which have implied volatilities close to their 1-year lows. How close? Let's look and see. So right now I'm seeing yen 103 was the high, 61.24 was the low, 61.24 was the last. Take a look at the last two columns and you'll see how close they are. So IoT 43.88 was the low, 46.48 was the last. MCHI 1982, 2049. NCNO 2642, 2760. I mean, a lot of these are very, very close to the lows with only YINN at an absolute low. So these top 10, Carvana's in that top 10, where its absolute low in the last year is 54. It's at 64.40. So sitting off that low, I would say, when you're looking at a 54 to a 64, that's 10 points off 54. That's going to be probably about 9% off the bottom. So, 19% off the bottom. Still cheap. If you use 50 as an average, still cheap. But let's look at something that's pretty close to its low. Most of these, by the way, are Chinese stocks and ETFs in terms of the ones that are very, very cheap. Who would have thought that we were going to come into a week where the U.S. markets had very expensive implied volatility and Chinese-related stocks and ETFs were on the cheap side? I never would have seen that coming. All right. One cheap optionable stock is Encino, NCNO. Stock price has gone from about $28.50 to a high of about $35. At the same time, you've seen that IV that's gone from about 55 down to a low of 28. The low actually happened about week and a half or so ago after they announced their earnings, and the stock dropped from around 34 and change down to 30, and it has since kind of hung out in that 30 area. All right. That's about a 48% less year-to-date move on volatility to the downside, about 40% month-to-date move from its high to its low. The options right now are, look at the IVs, 26 and 29. And you're talking about a 30 call, which was going for, this is really a slightly, it's almost at the money. When you've got a quote at 110 and the extrinsic is 109, it's right at the money. Okay. So at the money options are trading for $1. All right. The slightly out of the money, you're down to 8 cents, but that's the number to look at, is at 26. Look at what happened a month ago. This was a 45 and a 41. So much higher implied volatility. And then you can see here that this 30 call, which is in the money by a couple of dollars, it still had $1.15 of time value on it. And here's an out of the money that had 83 cents. When you compare that to the out of the money today with the same time to expiration, roughly, that has 8 cents.